Welcome back to another TradeOut's technical analysis learning module. This is the introduction to Fibonacci. This is a big one. This is something that I use every single day in my trading. It's very important. And, we're going to dive pretty deep into a lot of the different tools and methods that I use in my trading when it comes to Fibonacci. But we're going to discuss some of the basics and some of the theories behind it. That way we get a good understanding and foundation before we dive into those specific tools. That being said, let's get to the video. And here is the disclaimer. Please pause the video if necessary and read it in its entirety. As usual, all content is for entertainment and educational purposes only. Nothing is financial advice. All right, so we're going to start off with some basics. Fibonacci. And I'm going to try to keep it as technical analysis and trading related as possible. And you'll find out later on why that is. But first of all, we have the Fibonacci sequence. So you can see the sequence on your screen and it goes from there. So basically, if the Fibonacci sequence starts off with 0, then it goes to 1, then 1 to 2. And quite simply, the next number in the sequence is found by adding up the two numbers before it. So I give you 4 examples there. You literally are starting at the very beginning of the sequence. So 0 plus 1 equals 1, 1 plus 1 equals 2, 1 plus 2 equals 3, and 2 plus 3 equals 5. And it goes so on and so forth. And again, when you're adding up the two numbers before the number that you're trying to find, that's how you get the Fibonacci sequence. So looking at those numbers, do you see any numbers that stand out to you? So I'll pause for a second. So is there anything within that sequence that you have seen before in relation to technical analysis and maybe some types of indicators and stuff that you use? So anyway, quick preview on that. Let's move to the next one. And another Fibonacci basic, I would say, but this is probably the most important one, is the golden ratio. So the golden ratio is the 1.618. And, I really encourage you to actually research this outside of this video and see how the golden ratio applies to other things outside of trading, because I think it will blow your mind, like how impactful this ratio actually is outside of trading. So obviously, I will tell you right now, in trading, it's insanely important. This is definitely we're going to talk about this more in a bit, but the golden ratio outside of trading is incredible. And it's actually, like, if you actually do a bit of homework and find out all of the different things around you that have a relationship with the golden ratio, it's incredible. And it's no wonder why it works, in trading. I think it works quite well. But it's literally found everywhere you look. So whether it be in art, so you're looking, there's a picture of a nautilus shell there. That is the golden ratio. It's the one that's 1.618. So again, architecture, you look at the way flowers, your hand, for example, which I learned, which is pretty incredible. So like, think of your hand, going back to Fibonacci sequence, right? Your hand has 5 fingers. Each finger has 3 segments on it, like 3 sections, right? So again, Fibonacci sequence. You look at the number of petals on flowers, like they're directly related to Fibonacci sequence. Architecture, I already said that, but the way that some of the buildings are structured, it's just incredible. Like, it's actually worth doing. Obviously it's not directly related to trading, but in the trading sense, but it's just interesting to me. So anyway, that is the golden ratio, 1.618. Remember that, because it's very, very critical to Fibonacci basics. So we're going to go back to the Fibonacci sequence just for a second. And I think you're going to start to see where the golden ratio comes into play and how intertwined it is with Fibonacci. So again, the Fibonacci sequence, we went over it earlier in the video. And it's the same exact, it's the same exact one as the previous slide. But look at the bottom section of the slide. So the Fibonacci sequence in relation to the golden ratio, this is where it gets actually really, really interesting. So if you take two numbers within the sequence, obviously it's not going to work for the first few numbers because the numbers are too small, right? So like if you look at it, it's not going to work. But as you get a bit deeper into the sequence, you will see that so not only you know, obviously you have the sequence and how it is, you know, you take the next number in the sequence, you're able to find it by adding up the previous two numbers before it. But in relationship to the golden ratio, if you take one of the numbers, and so for example, we're going to use 89 and 55, which are both part of the Fibonacci sequence. If you divide 89 by 55, you get 1.618. And then if you inverse it and you divide 55 by 89, you get 0.618. It's incredible. Let's go to the next set of numbers. So if you take 144, which again is part of the Fibonacci sequence, you divide 144 by 89, you get 1.618. And no surprise, flip it around again, 89 divided by 144 is 0.618. So, and you could take that, you can go and keep working down the Fibonacci sequence, and you see that it is literally in direct relationship with the golden ratio. So how is this important? How does this relate to trading? Well, for the tools that we're going to be discussing for the rest of this entire learning module, those two numbers specifically are going to be crucial for the rest of the sequence. So that's why I'm spending a bit of time here kind of telling you where those numbers are derived from, that they're not just made up, and that there's, you know, again, to understand kind of the basics, the foundational aspects of, you know, of this theory that we're talking about, because again, when we get into the actual tools, you'll understand why I look at those specific levels more than I look at others, for example. So again, Fibonacci basics. If this is slightly confusing to you, it's okay. Go back and watch it a couple times. Again, it's not necessarily that you have to understand how these numbers are derived. It's just, it's reinforcing and showing you that these numbers are very important though. So now I'm going to talk about a few of the different tools that are available that are related to Fibonacci that I use every day in my trading. I'm just going to give a very, very brief overview of them, because in the rest of the module, we're actually going to break these down and go into, you know, deeper detail. But again, this is just an introductory video. So I'm just going to give you a brief kind of snippet of what they do. So again, Fibonacci retracements. This is something, again, if you're in the VIP group, especially, you've seen this pretty much every single day. And what the Fibonacci retracements are is simply a tool that's used to measure retracement targets. And you use them, you identify certain, you know, key market structure, and you're able to pull retracements from one point to the other. And they're going to give you essentially, you know, their targets to look for. So again, Fibonacci retracement, something that I use extensively in my trading, and we'll be going over in literally the next video actually. But you know, again, Fibonacci retracement, something that's very useful in this particular chart here. So this is Dixie, you know, this is literally the US dollar index, and you can see that, you know, when you run into it, you might be really hard to see on the screen, but this is your 618. So just what we were talking about in the previous slide, price literally runs up, makes a high, and where does it retrace to? Your 618 before getting a nice bounce. So again, we'll revisit that. You'll see this all the time in trading. Obviously, it's not perfect all the time. Otherwise, everybody would just use that literally every single time, right? But you'll see that more often than not, it is definitely a level that you want to be aware of. So more uses of Fibonacci. So moving averages, right? So whether there be, you know, standard moving averages or exponential moving averages or EMAs, one use of the Fibonacci sequence, which we discussed during the video, is using it to identify specific periods to use for moving averages. So if you think about it, you look at the Fibonacci sequence that's listed below, are there any numbers, and this, I had asked this earlier in the video, is there any numbers that stand out to you that are used in, you know, again, just for moving averages? Well, I can see a few. Very, very popular one is the 21 EMA, or the 21 moving average, right? That is one that is used quite often. The 13 is also used quite often, and the 55 is a big one, which is pretty close to your 50 period moving average, right? Or 55. That's one of the numbers that I like to use, and so on and so forth. But You know, I kind of have a bit of a funny story actually. So this was a few years back. I was actually in a group with other people, a trading group, and I had shown a chart that had the 377 exponential moving average on it, and people were looking at it like, why, like, no one uses that. Well, that's actually not true. And you know, people thought it's a made up number just because it had a really perfect reaction off of it. The point is, it's not a made up number. It is literally part of the Fibonacci sequence. So that is why, you know, especially on viewing things on for higher time frame type stuff, the 377 EMA is something that I like to know where it is. But again, it's not a made up number. It is literally part of the Fibonacci sequence. So that's why I use it. That's just one of the EMAs that I like to use. Again, we're kind of getting a little bit off topic, but the Fibonacci sequence is responsible for a lot of stuff that we do in trading. So another use of Fibonacci, one of the many uses, but this one is actually really powerful, is Fibonacci time. So what Fibonacci time is basically you're able to measure future potential key pivot areas, let's say, and it's measured in time. So you're able to identify certain periods in the future that could give you a heads up that something is going to happen, right? So you kind of think of those as pivots essentially, or potential market pivots. So again, you're using this tool. I'm gonna get, like, you're gonna see real examples later on in the module. But essentially, you're trying to find future dates. So you think of it, for those of you who are familiar with Ichimoku, it's a little similar to that in the sense of the Kumo, the cloud, is forecasted ahead of time, right? So that's giving you future support and resistance. Fibonacci time is essentially taking price action that's happened, and you have key market, key pivots within that price action, and utilizing that, trying to find periods of time, so like specific moments in the future where we could see structural changes in the chart. So again, might be a little bit confusing. We're going to give you real examples once we get into the Fibonacci time module itself, but one of those things that is overlooked a lot, but if understood and used, it can be very powerful. And one thing that is incredibly important is Fibonacci Confluence. So this is where this is something that I definitely use in my trading quite a bit. And it's simply when you have multiple Fibonacci levels lining up at the same level or the same region, when you see that happen, it gives you added strength to whatever level that you're looking at. So for example, which I'll walk you through here in the next slide, but essentially when you have multiple Fibonacci retracement pulls, for example, that could be at different points in the market structure. If you have Fibonacci levels that are lining up with each other, that likely gives you added strength, or gives you Fibonacci confluence, telling you that that level is probably likely to be respected, right? And another thing is, fibs are really great tools to use to add confluence to your other indicators. So this is one of the main uses that I use Fibonacci for. I do not trade Fibonacci on its own, right? Or let's just say I pull a random Fibonacci retracement somewhere, and I see where the 618 is. I don't just blindly take that trade, right? What I like to use it for is to see if I can get any other confluence with other stuff that I'm looking at, whether it be other indicators, whether it be other support resistance levels, exponential moving averages, pivots, everything that's listed here, right? Like there's other, it's really powerful when you're able to have those levels line up and add confluence to that trade. And now it's time for an example. So you can see this on a real chart. All right, so again, here we have Dixie. So the US dollar index. Okay, this is major stuff. So this is not even crypto related, but obviously, and like the point is, I just wanted to show that Fibonacci is everywhere. It is absolutely used in traditional markets. So if you're trading stocks, if you're trading ES, if you're trading Forex, it doesn't matter what you're trading, it's all the same theory, right? It's used the same way. So you would literally do the same stuff no matter what market you're trading. So again, here's Dixie. Here's an example of basically we had a nice local low here, right? Put in a nice range here. And this is right where Dixie started to get impulsive. So this is one of the areas of interest that I would like to pull. And then obviously you're going to take your, well, not obviously because this is going to come in the next video, but you start at your swing low here, and the top of your retracement is going to be at the peak of price. And what you're looking for is a pullback to specific Fibonacci levels. So in this instance, I'm always going to want to know, where is the 618? So where is the golden pocket, which we will be discussing in the very next video. But ultimately, it's the 618 that I'm very interested in. And sure enough, Dixie, this is like huge, major, heavily traded. You literally got your low to your high, perfect touch of your 618 before a really nice bounce to the upside. So this is using a Fibonacci retracement. And by the way, it looks like this. I just happen to, so this is essentially what your Fibonacci retracement is going to look like, but I just turned off the rest of the lines just to kind of keep it nice and clean for this example, just like that. And then another pull that you can do is this low. So this is a pretty major low here, right? So this is where we can look to see if there's any Fibonacci confluence for this lining up, okay? And as soon as you have your low and you have your high in, price starts retracing, then you know that you can use this as a point. Like, you don't obviously have to wait. Like, this is, you can find these levels way ahead of time. You don't have to wait for them to hit or anything. So again, as soon as this high is made here and price starts retracing, you can pull these retracements to see where are your targets. So again, this low here, this extreme low, all the way to the same exact pivot high. I have to zoom in a bit here. And then I'm going to change this to standard so that you get all the rest of the fibs line up. So do you notice something? Is there any one of these fib levels on this larger fib retracement pull that happen to line up with this 618? Well, on the larger pull, which I would argue is a very important pull because this is a very extreme low to the high, your 0.5 fib level right here happens to line up almost perfectly with this smaller pull, the 618. And look at that. Where does price come down to? You zoom in right here, it literally comes and touches right on this exact level right here. And you get a pretty substantial bounce off of here. 16.6%, which this is Dixie. This is a massive, massive move. So anyway, a really nice example of using not only one of the Fibonacci tools, the fib retracement, but also a very perfect example of Fibonacci confluence and why it's important. So again, it adds strength. We knew that the 618 of this pull is definitely a level to be aware of. But then when you have the larger fib pull in play, you get the 0.5 lining up perfectly with the 0.618, which we know the 618 is a very, very, very important number. And it gives you added confluence. It gives you added strength to this being an important level, and you get the nice reaction. So that is going to wrap it up for this introductory video. I hope that you enjoyed it, got a little bit of insight into the very basics of Fibonacci. Obviously, for the rest of the series, we're going to dive deep into each tool individually and show you other tools that I didn't even discuss here and how you can use that for your trading. But I hope that that was helpful. I hope it was informative. And again, the rest, you definitely do not want to miss the rest of this module because I'm actually going to go in pretty deep and show you how to use those tools. So here's my social media. Obviously, if you want to follow me, I spend majority of my day over in Discord. So that's kind of why it's listed up there in the upper right corner. Definitely, if you want to come in there and hang out, definitely should. There's, I think, almost 9,000 people in Discord. It's a very active community, and it's free to be in there. Obviously, I do have the VIP tier, which is available through Patreon at the moment. If you're interested, there'll be a link in the description below. I definitely am in there the entire day. But that's obviously if you want to hang out with myself and some other traders. who, you know, like it's a lot of fun to be in there. I'll just say that. But I have my Twitter, which I'm pretty active on there. Facebook, not so much. It's kind of a lot of spam on Facebook, so I'm not too sure if I'm going to maintain that page or not, or keep it. Obviously, you're watching this on YouTube, but that is my YouTube channel. And then Telegram. I think we have 3,300 over in Telegram, so it's also another active community if you prefer there. But anyway, trade safe out there. We'll see you on the next one.